knows a lot about all kinds of stuff. Professor Dave explains.
Imagine you had $5,000, but you had to keep it in your house. Since that's a lot of money, you might hide it in a secret place, but you probably would constantly worry about losing it or someone stealing it. Without banks, this is what we all would do. We would have no place to store or grow our money. A bank is an institution that allows people to deposit money into an account for safekeeping. People had historically been incentivized to start a bank account with the promise that the bank will pay them interest over time for keeping their money in the account. And in the past, this interest had been substantial. But if that was all banks ever did, they'd never make any money themselves. Instead, they would lose money having to pay interest. But banks are also financial institutions licensed to make loans and offer other services that earn money for both parties. When you go to a bank that you have an account with, you can withdraw your money at any time, and you don't have to worry about whether or not the bank actually has money to give you. Banks offer many ways for people to save money. The four most common ways are savings accounts, checking accounts, money market accounts, and certificate of deposits, also known as CDs. Savings and checking accounts often pay interest at an annual rate. These accounts offer hardly any risk, but the financial cost is that the interest is very low. In other words, you can't make much money through savings or checking accounts. Money market accounts and CDs are special kinds of savings accounts that pay a higher rate of interest. With money market accounts, you can withdraw a limited amount of money, but the interest rates are not fixed. They can go up or down. With CDs, you get a guaranteed rate of interest, but you can't touch your money until the end of a certain time period. Let's say you have $25,000 in a CD, and you can't withdraw the money for 2 years, but you are guaranteed a 3% annual interest rate. At the end of the first year, your CD will have earned $750. At the end of the second year, when you can withdraw your money, your $25,000 will now be $26,522.50. It's not a whole lot, but it's still extra money as a reward for saving. Perhaps the most important thing banks do is provide loans. In fact, banks take the majority of customer deposits to lend to other customers for a variety of loans. The difference between two interest rates is effectively the profit margin for banks. By providing loans, banks help new businesses get started, and they help already established businesses grow. When a business gets a loan, that business can create new jobs by hiring new workers or investing in capital in order to increase production. A business that gets a loan may also help other businesses grow. For example, say you and your friend want to start a coffee shop. Your coffee shop will need supplies, like coffee beans and espresso machines, so the farmers who grow coffee and companies that make espresso machines will also benefit. They may even hire workers to expand their business. Banks also provide loans to consumers. For example, they loan money to people so they can buy cars, which are expensive and difficult for most to pay for all at once. Consumers also borrow money from banks to buy homes and pay for college. Remember, this is how banks profit, as they earn money on the interest they charge to consumers. This doesn't mean just anyone can get a loan. Often, a consumer has to establish a good credit score, which is a number that predicts how likely they are to pay back a loan on time. If a borrower were to default or fail to pay back their loans, the bank may lose a big part or even the entire amount of the money it has loaned. Therefore, bankers often consider the credit score of the borrower to make sure the loan isn't too risky. A mortgage is a specific type of loan that is used to buy real estate. Suppose a family wants to buy a house for $350,000. It is unlikely that the family has $350,000 in cash sitting around, so like almost all home buyers, they would need to take out a mortgage. The family can afford a down payment of $50,000, so the loan would be for the remaining $300,000. According to the terms of their loan, the family is responsible for paying back that amount, plus whatever interest the bank charges, in regular monthly payments for 25 years. Typically, mortgages last for 15, 25, or 30 years. To summarize, banks play an important role not only in the overall economy, but in our day-to-day lives. They offer a service for people wishing to save their money. They provide loans to new businesses and established businesses wishing to expand. These loans are crucial in helping an economy grow. Finally, banks give consumers and producers an opportunity to invest. But often, banks can only do so much to help you invest your money. In the next tutorial, we will look at more ways to invest your money so that it automatically grows, without any extra effort on the part of the investor.
Thanks for watching. Subscribe to my channel for more tutorials. Support me on Patreon so I can keep making content. And as always, feel free to email me, ProfessorDaveExplains@gmail.com.